Hello, everybody. I'm Andrew Boudry. Welcome to Your Bread and Butter Podcast.
And I'm Ryan Cummings. Today's episode is Mining for Meaning, digging into cryptocurrency's role in your portfolio. The goal today, talk a little bit about what is cryptocurrency. If you're someone who wants to invest in it, what should you be thinking about before you do so?
You know, I've invested in crypto and I sleep like a baby. Yeah.
You do?
I cry every night. See you soon.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Welcome back, everybody. Today, cryptocurrency, its role in your portfolio. We're going to talk about some of the basics, help you understand a little bit more of what exactly is crypto, the kind of landscape surrounding it, and then we'll dive into the more technical stuff of if you're someone who does want to have an investment in cryptocurrency and have some exposure within your portfolio. How do you go about doing it, and how do you do it in a way that's safe and that makes sense for an investment portfolio?
So, you know, right now we're going to watch what happens here, but they're trying to make crypto available inside of people's 401ks and other retirement programs. And so I think that even if you have no interest in crypto, it's really smart to just know what's out there in the investing world. And I know I was at an event recently where we had some people behind me and I was watching this game, and the two guys behind me, there's one guy was bragging about all the crypto and the money he's made and all this stuff, and he was trying to convince the guy to get into it. And, you know, when his friend said, yeah, but what happens if, you know, and he did this thing, and the guy's like, well, I guess you'd lose it all then. And I'm like, okay, there you go. That's kind of like the way you want to understand about this, is that this is a very new territory, and you just want to make sure that greed doesn't get in the way of making a good decision. So that's what we're really here to talk about, the basics, so you at least understand what's going on out there. And then when you go to a party, if you ever want to find out who's invested in crypto, just listen, and they're telling somebody about how much money they made. So
Right. And don't get me wrong. I mean, if you've invested and done it correctly, you may have made a lot of money. But the point with cryptocurrency is not that there's potential there or not potential there, but rather that there's risk that comes with it, and making sure that with any risky investment, and that's kind of the, you know, I think investing, one of the basics of any investments, whether it's crypto or whether it's more traditional stocks or things of that nature, is, you know, trying not to get caught up in the greed factor and making sure that you're aware of not only just the upside, which so many people like to advertise, but also the potential downsides too. And, you know, you're okay taking that risk when making that investment.
Exactly. So let's start with the basics. The digital money, it doesn't have a middle person, a middle man. Cryptocurrency is a digital form of money. It's built and exchanged on what they call a blockchain, which is like a shared online ledger that everyone can see, but no one can easily change. So unlike dollars or euros, it's not issued by a government. It's decentralized. Doesn't mean that one day won't happen one day, but right now it's a decentralized form of currency.
Right. And that is one of the big things that a lot of the proponents of Bitcoin and other cryptos do like about them, is their decentralization. But there are also different types of cryptocurrencies. There's your coins, your more traditional cryptocurrencies. These are like your Bitcoins or Litecoins. They're designed to function as a currency, as a middleman and exchange, a medium exchange, if you will. But whereas you have other cryptocurrencies that are in the category of what we call tokens. So these are like Ethereum or a Ripple or Stellar Lumens, for example, name a few. Now, these are often representing maybe something else, like a specific project, a function of some kind, ownership of an underlying asset, or or even voting rights for a particular company. These different tokens can do something a little bit different, and so gone are just the days of hey, Bitcoin, it's an alternative to the dollar. There are these other projects out there that are actually doing different things.
Right, and they all have their own volatility factor.
They do.
So Bitcoin could go down or up one day, and these other ones would would have no interrelated connection to that. So how it works is blockchain 101. Every transaction that we are making online is verified by multiple users called nodes and recorded permanently. So once they're added, the record can't be changed. And this transparency builds the trust without needing a bank or a broker. This is a very important part of the story.
Yeah, it's the idea of security and the deregulation of cryptocurrency. It's again one of the aspects that appeals to it. So an analogy, you can kind of think of it as a group chat that never deletes their messages, and everyone can read the receipts on it. And so it's that kind of permanent history and record keeping that does add some security to it. But at the same time, with the deregulation, there's the higher risk that comes with that, and people trying to use this level of security for maybe less than reputable transactions.
Correct.
This is the best way to put it.
Correct.
But if you look at the history of Bitcoin, it was created back in 2009 for really out of distrust of traditional banking. And it's kind of, evolved as time goes on of, a very basic rudimentary online currency to kind of some speculative investment component to it, to then more so in curiosity. And then now really is kind of an emerging alternative investment asset as part of almost really the standard portfolio these days.
Yeah. And I think part of what is that there's companies out there that people own in their portfolios that are directly related to some of the institutional curiosity that we talk about. And those companies are actually making headway in it. And Bitcoin, if I'm not mistaken, is actually, has a very limited supply of coins, and that increases the value up because there's only a finite number of coins available out in the computing world. And so owning one of those Bitcoins gives you a lot of value because there's only so many of those to be made.
Right. So that's part of the value there. And then, I think it's when you're investing in Bitcoin, you want to make sure that you're doing it for the right reasons. You are maybe investing in it for the potential for the growth, but you're also not letting yourself become victim to that emotional side we've kind of alluded to of, having that fear of missing out, or, you hear the stories of the people that, became millionaires overnight. Like those stories are so few and far between. A lot of them actually may even just simply be made up. There are maybe a few here and there where you've seen people that have made substantial amounts of money, but it's not something that the average person can expect with this sort of investment.
Right. And we're not experts in this. And just in full disclosure, this is something that's relatively really new. Even though 2009 is like 16 years ago, the whole concept of this Bitcoin theory has been around for a while. But as far as it becoming more institutionalized, we're talking about exchange traded funds that now are represented through Bitcoin, corporate adoptions to this, where we have a lot of coins being made out, a lot of tokens being made, and we've had some crashes.
Or big companies that are investing in cryptocurrency.
Yeah, big company investment, right? And we also had Sam Friedman there, who lost billions of dollars of people's money.
Right.
So, there's been some pretty significant crashes, but we're not experts in it. We're just trying to give you the basic guidelines here as to how this works.
Yeah, I think the key is we're going to approach this from a financial advising perspective and an investment perspective, and try to help you essentially learn how to invest in Bitcoin, but do it with discipline, proper diversification, and proper skepticism, as you incorporate it into your portfolio.
I think what drives a lot of investors these days to this dynamic is just the fear of missing out.
Yes.
Like, how come I'm not in there? I want to be a millionaire overnight kind of thing. So you do have to kind of step back a little bit. So let's take a look at this chart and the differences between stock and cryptos. And again, we're looking for balance with all of our clients' portfolios. We recommend the same thing for you.
Some of these we've already mentioned, but it's important to understand when you're adding crypto, there's a reason we call it an alternative investment. It's going to be more limited, and we'll talk more about that limitation in a minute. But when you when you look at the differences between traditional stocks, there's much less regulation in the crypto world, 24/7 trading. So that means while you're potentially sleeping, there could be rather large fluctuations in the price due to trading happening at all hours. As we already talked about, it is decentralized versus your traditional stocks. It's much riskier than your traditional stock investments. We'll talk more about that in a few slides. And then a big one, and I think it adds to the risk side, is there is no intrinsic value. For at least most cases. There are some of those token coins now that are coming out that are backed by projects or companies. There's a little more intrinsic value with those.
Correct.
But your traditional cryptos, there's nothing backing them. With a stock, you have a company. It's not just the price of a stock. You have a company, a living, breathing company that is backing the value of that stock price. A lot of these cryptocurrencies, the price of it is just simply based on how many people bought it, how many people sold it.
And the demand.
Yes.
So you have to be a little bit cautious to it because, again, because there's no real value behind it, if some technology is developed that actually takes away the use of that blockchain, it could become worthless over a very short period of time. So we want to look at similarities, which is, there, but it's part of an investment strategy, but the prices are going to fluctuate based on supply and demand, just like stocks. But again, key is there's not a lot of regulation around this right now. So.
There isn't. So if you're someone who wants to invest in cryptocurrency, what is the case investing in crypto? Why do some people, maybe yourself included, if you're listening to this, why do you want to invest in crypto? Well, I think some of the pros that a lot of people are shooting for, especially the clients we talk to that sometimes come to us with a desire to invest in cryptocurrency. The biggest one is the potential for high portfolio growth. That is, I think, a big one that most people focus on.
Right.
And yes, cryptocurrency has, over the last 10, 15 years, it has outperformed a lot of assets depending on the cryptocurrency you're looking at. For example, Bitcoin's really the only one that's been around for quite that long. But yes, many of them have outperformed maybe your traditional stock assets, but not without lots and lots of ups and downs along the way. So while they have outperformed maybe on just simply the growth side over that same period, there's the risk of, what if you happen to need that money mid-cycle when you're experiencing maybe not just the high, but the down. And the other key thing to know with high growth periods like this is a period of 10 to 12-ish years of great performance does not guarantee another 10 to 12 years.
If anything, statistically, it means that there's likely something that's going to happen to that. But it does bring portfolio diversification, which is not a bad thing.
And I think a little less than some people think, though.
Yeah, because of the investment itself and how many institutions are involved in it.
It does. And also with the, I was reading an article about it the other day, even the correlation with stocks and bonds. Crypto is positively correlated with stocks and bonds. So that means that, if stocks go down, so does cryptocurrency. You're not getting some hedge to your stock portfolio. Yes, it does give you a different type of exposure, but it's not this complete reverse or hedge to your stock investments that some people sometimes believe it to be.
It's not 180 degrees opposite, is it?
Right.
Well, it's just like the other day, I have a silver dollar that I've had for a long time, and I dropped on the floor, and my dog chewed on it. So now I've got a Bitcoin. So if you have any choice where you can get some investing, you can hedge against inflation with it against the traditional markets. That's one way it is a hedge, is it is the opposite of the traditional markets because of all the things we mentioned earlier, that it doesn't correlate with no, real guidance or real oversight, none of that. So.
Right. But as far as some things to be cautious about, we've already kind of alluded to a few, but just to point them out, it's got extreme volatility. We're talking one of the most volatile in asset classes out there as far as how fast it falls and how fast it rises. And a lot of it's highly speculative. Again, there's not that intrinsic value, that physical thing backing the value of them. You're having to speculate on, are other people going to have a demand for this? Are they going to buy it at the same time you buy it? And you want to, if you're going to build that plan for crypto, make sure you set, a plan for when you're going to buy in and when are you going to sell some out and take some profits.
Now, to take a more traditional investment item to kind of compare it to Bitcoin would be gold. So gold's had a just a great run up over the past year and a half, 2 years. But gold also languished for many, many years, and really over a long period of time is not really a great inflationary hedge. Well,
Right.
since this has really only been around really about 16, 20 years at most, we don't really have a track record as to how much that would hedge against for inflation. So, but with gold, if you own a bar of gold, what do you do with it? It won't feed your family. It won't.
Right,
It's only
right.
going to go to the bidder that was willing to pay for it. Same thing is going to be true for Bitcoin. It's only going to be as valuable as somebody's willing to pay for it, particularly if it doesn't give any functionality to your own life, to your own
Correct.
stuff. So
Right.
I think also, too, to be cautious, as we mentioned earlier, the lack of regulation and no real consumer protection. That's,
You hear stories all the time, I feel like,
Oh.
of people, losing their Bitcoin wallets or having it hacked and being
or
out
getting
that money.
kidnapped like the guy in New York,
Yeah.
so somebody could
Yeah.
steal his Bitcoin. So,
Right.
wow. But the environment and security concerns about this are very real. People can go in and steal these Bitcoins as well, but there's an environmental impact that's tied to some of the computing that's going on for both AI as well as this whole Bitcoin mining
Right.
as they're going in trying to mine these things, and going back to your title. So we have to be really careful. But where does it fit? Where does it fit in a portfolio? Because there is a fit for it. So let's talk about where it fits.
Yeah, so the idea here is it's going to fit in that alternative category. So you can kind of maybe position it as like a smaller, almost satellite asset within the portfolio. So it's something to complement a more broader, well-balanced portfolio, but should not replace your core diversified assets. I mean, we were even sent an article, what was it, a few weeks back, about a rather large company, investment firm, that was suggesting in the realm of 40 to 45% of client portfolios in cryptocurrency. And part of that was due to we were just talking about, the performance.
Yeah.
While it has outperformed a lot of assets over the last decade or so, it doesn't guarantee it's going to do that going forward, and it's missing a lot of the safety, the downside of what if it doesn't. So instead of maybe 40, 45%, I think we'd like to see most of our clients in the maybe 1 to 5% allocation.
Yeah, 4 to 5% would be where I'm going on that.
5% or less, really, just kind of keeping that 5% as maybe your top market line there of, if you're wondering, well, how much should I invest? Keeping it small, below 5% is the goal.
The only thing I would say, too, for all of you out there that do own Bitcoin or own something that's really grown in value, the reluctance for people to sell these kind of assets, it's real.
Yes.
They watched it grow. They're like, oh, I only paid $8,000 for it. Now I got $190,000. Okay, I get that. But at what point do you take some of that money off the table when you have an unregulated asset? It's not like you own some, big super company like Google or Apple that make products, they're brick and mortar, or they're heavy in the tech world. I mean, those are real companies that are going to go on. But you don't know that Bitcoin or the meme or token things that you're buying, you don't know what the value is behind those and how well they're going to really last.
And I think a simple principle there is, stick to standard portfolio design. So if you do, let's say, make some decent money investing in a cryptocurrency, it grows in value. Maybe, like you said, you invested $8,000, it became $108,000. Well, if that now exceeds 5% of your portfolio, harvest gains, re-diversify. Do what any disciplined portfolio manager would do, is when one asset skyrockets, they don't just hold on to that and hope the roller coaster ride continues.
Yeah, because once you sell
they diversify out.
Once you sell it, you've realized the gain.
Right.
Hopefully, it's not a short-term gain. You're getting a wackadoodle, but get good advice from your tax planners and how to do that. So the different thing here is you're not trying to strike it rich. You're just putting it in as a new asset class. And then there's different ways to get exposure, which do bring a little bit more to the table as far as somebody managing your assets.
Yes.
And that could be, could be direct ownership. That could be one way, as we've been talking about, or it could be crypto ETFs and mutual funds.
Yeah, it's a much more accessible way to invest in cryptocurrency instead of having to create a wallet and do it on an exchange that you're specifically buying these different tokens or coins. And you could just include it as part of your regular investment portfolio. If you have an IRA or you have a brokerage account of some kind, just invest in a ETF that you either get access to different cryptocurrencies. There's some that are specific to different coins. You can get ones that are actually diversified, which I like even more, diversified within the crypto market. So instead of just having 5% of your portfolio in Bitcoin, you can invest in an ETF that has 20 different cryptocurrencies in
Correct.
it and have that make up.
At least give
5%
yourself
of
a
your
little
portfolio.
diversification within
Right.
that. And then you have your blockchain themed funds that invest in companies that are building infrastructure. And so those are a little bit safer, as we talked about earlier. They have a little bit more of that intrinsic value because they're backing up real projects, real companies doing real things. It's a little bit safer, should be a little less volatile. But bringing that up, we have to manage risk and volatility.
Yep. So manage expectations with the cryptocurrency. I say it all the time to people investing in it. Only invest what you can afford to lose. If it goes to zero, you need to be okay with that. It cannot be a make or break amount of money that you're investing in that asset. Make sure you do also keep some emergency funds and your core goal separate. Don't invest your child's college fund in Bitcoin is what that is essentially referencing. And then understand again that it trades 24/7. So as we were talking about earlier, you could go to bed with a ton of money in your Bitcoin wallet and wake up and it's cut in half. And that can easily happen and does happen from time to time.
And the IRS is going to be happy to cut some of that more in half for you. So make sure you take out those tax considerations because short-term capital gains that are under 13 months, you're looking at a 28% wackadoodle from the federal government, getting at your money. Long-term capital gains, it could be, 10, 15, and the 20%, depending on whatever the capital gains are. So, long-term is a little different. 13 months in a day, that's a little different. And I think those are tax considerations you should be careful about. As well, look for your behavioral finance. That's a really big part of this whole crypto.
Yeah, it's mostly the emotional side of things. Again, the people that have that fear of missing out, the greed, the fear, this hype on social media that can entice people to want to invest. And, again, just like, we've quoted him before, I'll do it again. You quote Warren Buffett and, his statement that he references all the time is, be fearful when people are greedy and be greedy when people are fearful. And
exactly. When
people are greedy and want to invest in cryptocurrency, and have this craze of money flooding in, it often means that we're potentially at a high and we could be looking at some sort of correction. So
I have, in my 36 years, I have seen it constantly over and over and over again where, greed becomes the driving momentum factor. And then when the reality sets in and it falls, that's actually the Warren Buffett time to buy.
Right.
So it's like, in the middle of a fire, you rush in, everybody else is rushing out, you rush in and you buy the most valuable objects that you can find, pulling it out of the fire. So that's an important part of sticking to a plan versus, some sort of emotional momentum. Be careful about that.
Right. And then so lastly, when you're building this into your portfolio, and work with an advisor if you need that extra help. You don't have to. You can do it yourself. But if you're someone who wants that oversight, an advisor can help figure out, well, is this investment suitable? Is your personal tolerance for risk in line with the risk you're going to be taking with this cryptocurrency investment? And they can really help you hopefully avoid that all or nothing mentality of just trying to funnel a ton of money in more than you should and, ride the roller coaster when in reality there's ways to take advantage, as we've already discussed, take advantage of the benefits of crypto without getting crushed by the downsides.
Yeah, we've all seen in movies and stuff where a guy goes to the casino and wins all the money. I'm going to put all my money on number 14 black, and then all of a sudden everything's gone.
Right.
The truth is that I've actually watched people do. I'm not much of a gambler. I don't actually really like it, but I don't mind watching people, gamble.
Yeah,
I've actually seen it live in person when people, putting $100,000 something on a certain number. They're going to win it all right here, and it's all gone. So watch it. It's rigged.
Yes. So hopefully you understand a little bit more about how to incorporate Bitcoin into your portfolio or any crypto. But what are some things to think about within the cryptocurrency landscape, as we see progress into the future? Because there are some things I think to be optimistic about.
Yeah.
And I think why we're getting more and more questions. on including crypto in a portfolio. But
I think the biggest one is institutional adoption.
It is.
Wall Street's and major corporations are integrating blockchain and crypto exposure, both and through the spot Bitcoin ETFs, custody solutions, regulatory frameworks, slowly adding some legitimacy to it. So not totally opposed to any of that. I think that's a really good idea because the more legitimate players you get in the game, the more legitimate it potentially can become.
Right, and I think in addition to that, the regulatory developments. I think even though deregulation was one of the big attractive pieces of cryptocurrency early on, the value of cryptocurrency could see a massive upswing with additional regulation. So even though some people, maybe the grassroots fans of Bitcoin and other cryptos may be opposing the regulatory developments, if you're someone who's just investing now and you're wondering, well, a lot of these cryptocurrencies are at currently some all-time highs or very close to them. Where is there additional room to grow? There very well may be, especially if we see some, additional government adoption, some additional regulation by the government, because that legitimizes it. That helps restrict the market, which is actually a good thing for security purposes. And that helps add this oversight that allows even more people, retail investors and institutional ones like you mentioned, to get access to these investments and ultimately increase its value.
Yeah, and beyond just simply being a currency, the blockchain revolution has some really good side effects. We're going to have more smarter contracts, programmable agreements that execute automatically based on certain levels that are built within that blockchain. So as things move along, you're guaranteed that one step was completed, the next step will move on to the next step, and here we go to the end. So this idea is good. Tokenization is also a good thing because real world assets like real estate, art, stocks can be represented digitally. So there are some real legitimate things about tokenization.
And even the utility of the decentralized aspect of it, being able to still lend, borrow, and trade without traditional intermediaries. Even if the government does regulate some cryptocurrency, they're likely not ever going to be able to regulate all of them. There's always going to be new ones being created.
No. In fact, my theory on government from my political science background and all of that is basically once the government figures out how they can make some money on it, they'll legalize it and they'll get it done. So, but that's true whether it's cannabis or
any
currency, so.
And then as far as the continued road ahead, crypto, is a continued part of the broader digital transformation, not necessarily replacing traditional finance, but being that, alternative, coexisting with it. That's again why we're talking so much in this episode about not foregoing your traditional finance investments, but supplementing them with this sort of investment.
And you have to be careful. You got to watch it as it's more of a speculative short-term versus a transformative long-term potential. It's more short-term in the time being where we are now. It's not really part of transforming your long-term potential, though. The winners of the whole Bitcoin and digital cryptocurrency, the winners may not be the coins you've heard of, but the technology behind them as they develop quantum computing and a few other items that are in this ballpark called cryptocurrency.
Yeah, I think that's a good point. A lot of the technology that backs it may be
the money,
the better investment,
exactly.
Going forward. But who wasn't really a big fan of Bitcoin?
Not sure.
Superman. He wasn't. He didn't really like Bitcoin because it was his kryptonite.
I can see that weakening his story. Of course. Well, let's talk a little bit about some takeaways on this, about what crypto really is.
Yeah, so it's, as we talked about at the beginning, it's a form of digital currency, or you have those token forms too that are alternative projects or different companies that are being backed by these different cryptos, but it's expanded. It's no longer just the alternative to the dollar. There's a lot of different utilities out there. And as we talked about, it's the technology too that's backing it. It's not just the coins themselves anymore. So you want to make sure if you're going to invest in it, you're investing in all of it. But we want to reiterate some of the risks that we you want to be aware of and before we wrap up today?
Yeah, I mean, I think you have to be careful as it fits into your broader plan of everything. The truth is, it is exciting, but it is risky, and you want to be really cautious that your excitement, the emotional aspect, this doesn't overtake your risk factor. So that's a big part of it. But you got to review your portfolio. Talk with your advisor before making crypto-related investments. If you're very secure with yourself in this and you want to take your money, as you said earlier in our podcast here today, if you can't afford to lose it and you're doing this on your own, don't do it. If you can't afford to lose it, don't do it. You know, we've had episodes where you're talking about, you know, cutting your costs and, you know, maximizing your income. Well, you don't want to cut out your investable assets by making a bad choice where all of a sudden it's gone. So sit down with your advisor, get some advice onto your portfolio. And really, we hope that you've taken time today to go through this. And if you have any questions, please email us. Tell us your thoughts, and we'll try to go through it for you and answer that question. Remember, though, live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Thank you for watching.
Bread and butter.